Silver isn't just holding a price right now, it's defending a structure. After a sharp fall from its all-time high that shook out the weaker hands, it's now consolidating above $82, a key Fibonacci level. But serious observers are asking the real questions. Is this controlled recovery just the start of a much bigger move-up? Or is the market quietly building up to a critical decision point right below major resistance? History shows that when silver stabilizes this early after a correction, its next move is rarely small. Either momentum builds with institutional money flowing in, pushing it higher, or the rally fades under pressure. This next move won't just impact traders, it will ripple across entire industries. Welcome to Financial Reveals. If you prefer clear signals over market noise, consider subscribing for informed awareness. Let us know in the comments, where are you tuning in from today? Yet price began stabilizing near the $64 warehouse level. The recovery was not dramatic, it was measured. Buyers did not chase aggressively, they accumulated gradually. Higher intraday lows started forming. Follow-through buying appeared for consecutive sessions. Then silver reclaimed the 23.6% Fibonacci retracement of the recent decline. In trending markets, this level often acts as early structural support. When price holds above it, it suggests demand is stronger than expected. It shows that sellers are losing immediate control. Now silver trades near $82 an hour. Round numbers attract liquidity. They act as psychological reference points. When price stabilizes near such levels after a correction, it often reflects institutional positioning rather than emotional speculation. Silver carries two economic identities. It is an industrial metal used in manufacturing and technology. It is also a monetary hedge during uncertain periods. Strength in silver can therefore signal expectations about both economic demand and inflation risk. The recent recovery from $64 was structured, not chaotic. It showed controlled participation. That behavior aligns more with accumulation than short-term speculation. However, caution remains necessary. The broader downtrend from the all-time high has not fully reversed. Holding above the 23.6% retracement suggests potential, not certainty. If 82 per dollar continues to act as support, upside probability increases. If it fails, renewed selling pressure could emerge quickly. This level is not random. It represents a decision zone where buyers and sellers test conviction. For business leaders and capital allocators, silver's behavior here may provide early signals about broader economic positioning. If strength persists, it may reflect confidence in industrial recovery or concern about currency stability. If weakness returns, it may confirm that the corrective phase is still dominant. The market is not announcing its intention loudly, it is revealing it quietly through structure. And what happens next will determine whether this recovery becomes expansion or fades back into caution. The recovery in silver is no longer just about price climbing from $64 to $82 an hour. It is about how that climb is happening. In financial markets, the way something rises matters more than the fact that it rises. Observers began to notice that silver was not jumping aggressively in one session and collapsing in the next. Instead, it was building pressure gradually. The buying did not look emotional. It looked structured. When analysts reviewed the moving average convergence-divergence indicator, they saw a clear shift. The MACD moved into positive territory. The MACD line crossed above the signal line. The histogram began expanding upward. For many retail traders, these are just technical signals. For experienced capital managers, they represent something deeper: alignment. When momentum indicators turn positive while price reclaims a Fibonacci retracement level, it shows that internal strength supports the visible move. This reduces the probability that the rally is random. At the same time, the relative strength index hovered around 50 and slowly nudged higher. This detail is important. An RSI reading near 50 during a recovery phase shows balance. It means the market is not overbought. It is not stretched. It has room to expand. When strong trends begin, RSI often climbs gradually from neutral levels, rather than spiking immediately into extreme territory. The business community should understand what this combination suggests. Momentum without overextension often indicates sustainable movement. It signals that buyers are participating without emotional urgency. Another key observation lies in volatility behavior. After the sharp pullback from the all-time high, volatility spiked. That is normal during corrections. Fear creates fast price swings. But during the recovery, volatility began compressing slightly while price advanced. Compression followed by expansion is a common pattern in financial markets. When volatility tightens and price holds above structural levels, it often precedes a stronger directional move. However, no recovery is complete without testing conviction. Silver is still trading below the 200-period simple moving average on the 4-hour chart. This average represents longer-term balance. Institutions monitor it closely. As long as price remains below it, some participants will remain cautious. If silver closes decisively above that moving average, it will change the risk equation. It will suggest that the recovery is not short-term but structural. Until then, the market remains in transition. The acceptance above the 23.6% Fibonacci level adds weight to the bullish case, but true confirmation requires sustained higher lows and continued positive momentum. What makes this phase unique is the behavior of participants. Retail traders are still hesitant. Many remember the sharp drop from the peak. They fear another reversal. Their hesitation reduces excessive speculation. Meanwhile, stronger hands may be positioning quietly. Markets often move strongest when doubt remains high. Historical patterns show that silver tends to recover in stages after deep corrections. First comes stabilization, then comes cautious optimism, finally comes expansion, if the macro backdrop supports it. Momentum indicators suggest the market is entering that cautious optimism stage. Yet risk remains. If price fails to break above longer-term resistance and momentum begins to weaken, the recovery could stall. MACD would flatten, RSI would roll over, buyers would lose confidence. That scenario would reopen downside risk. This is why internal signals must be monitored continuously. For business leaders and capital allocators, this is not about short-term trading. It is about identifying shifts in underlying strength. When metals like silver begin building momentum while holding structural levels, it often reflects broader economic positioning. It may indicate expectations of stronger industrial demand. It may signal concerns about currency stability. It may reflect renewed interest in tangible assets. But the story is not complete. Momentum has turned positive. Structure is stabilizing. Buyers are present. Now the market approaches a more difficult test, and that test will determine whether this recovery transforms into expansion or fades back into uncertainty. The market is now approaching a line that separates recovery from conviction. Silver's climb toward the 86.25, 86.30 region is not just another upward step. It is a confrontation point. This level represents a technical confluence where two major forces intersect, the 38.2% Fibonacci retracement of the broader decline and the 200-period simple moving average on the 4-hour chart. When independent resistance factors align at the same price zone, algorithms notice, institutions notice, liquidity concentrates. This is where reactions become meaningful. During strong recoveries, price does not simply drift through confluence zones. It either accelerates with force or hesitates visibly. The response here will reveal whether the recent strength is supported by institutional capital or merely short-covering activity. The 38.2% Fibonacci retracement is not arbitrary. In market psychology, it often acts as the first major counter-trend barrier during corrective phases. If the broader downtrend remains dominant, sellers typically defend this level aggressively. At the same time, the 200-period SMA represents longer-term balance on the 4-hour time frame. Many funds use it as a filter for trend bias. Sustained trading below it keeps models cautious. A decisive close above it forces recalibration. Therefore, 86.30 is not just resistance, it is a decision node. If silver approaches this zone with expanding momentum, strong MACD histogram, RSI climbing above 55, and steady higher lows, the probability of breakout increases. That scenario would open the path toward the 50% retracement near $92, or 95s. However, if price reaches the confluence with fading momentum, the story changes. A stall, rejection wick, or multiple failed attempts would indicate supply remains dominant. Markets often disguise distribution as strength near resistance. From a strategic standpoint, this stage matters for capital allocators. A breakout above confluence resistance often triggers secondary buying. Portfolio managers who waited for confirmation begin entering positions. Industrial hedgers lock in forward contracts. Volatility expands. But failure creates a different chain reaction. Rejection reinforces the broader downtrend narrative. It pressures recent buyers. It invites short positioning. It increases the probability of a renewed pullback toward mid-range supports. Silver has historically shown sharp reactions at retracement clusters. When it breaks through decisively, continuation can be powerful. When it fails, retracements can be equally aggressive. There's also a macro overlay. The US dollar's behavior and real interest rates influence silver significantly. If yields stabilize or decline while silver tests resistance, breakout odds improve. If yields rise sharply, resistance becomes harder to overcome. Thus, this is not purely technical, it is structural. What makes this moment unique is the sequence leading into it. Silver did not rush into resistance in a vertical spike. It built gradually from 64 to $. It reclaimed early Fibonacci support. It stabilized momentum indicators. This suggests preparation rather than exhaustion. Still, preparation does not guarantee victory. The 86.30 zone represents the first serious challenge to the recovery narrative. A clean break and acceptance above it would shift market psychology from cautious optimism to strategic positioning. On the other hand, rejection would confirm that the broader corrective phase remains intact. In that case, the rally from $64 a square would be reclassified as a counter-trend bounce. For decision makers, the message is clear: watch reaction, not prediction. Markets reveal intent at resistance. If silver holds firm above the 200-period average and converts it into support, capital rotation toward metals could accelerate. If it fails, patience becomes necessary. The coming sessions will not simply determine short-term price direction. They will define whether this recovery evolves into structural expansion or retreats back into defensive territory. The movement in silver is not isolated. It does not exist in a vacuum of charts and indicators. It reflects positioning, expectation, and economic tension. When a metal like silver stabilizes after a sharp correction and begins rebuilding above structural levels, it often signals that something larger is adjusting beneath the surface. Business leaders should not treat this as a trading story. They should treat it as an early warning mechanism. Silver sits at the intersection of two powerful forces: industrial demand and monetary protection. When it strengthens, it can indicate rising confidence in manufacturing activity or growing concern about currency stability and inflation persistence. Right now, silver is attempting to transition from recovery into confirmation. If it sustains strength above resistance zones and reclaims longer-term moving averages, it may reflect capital rotation back into tangible assets. This matters for entrepreneurs and executives. If raw material prices begin trending upward again, cost structures change, manufacturing margins tighten, hedging strategies become essential. Companies dependent on electronic components, solar infrastructure, or industrial equipment feel the pressure first. Have you been watching commodity prices lately? Historically, big moves in commodities, like what we're seeing with silver, can be an early sign of wider inflation. When metals bounce back after a big drop, it tells us the market is rethinking supply and demand. And this isn't just about commodities. It ripples out, affecting bond yields, currencies, and even the stock market. For investors, if silver breaks through its current resistance, it's a strong signal to consider diversifying into hard assets. It suggests a shift away from pure speculation and toward the real economy. But be careful. If it fails to break out, it could mean inflation fears are cooling off. And the main takeaway isn't to predict, but to prepare. Markets often give subtle clues before making a big move. Keeping an eye on these signals helps you stay ahead of the curve instead of just reacting to headlines. Thanks for watching, and don't forget to subscribe for more insights. When metals regain strength after corrections, it changes investor sentiment, it increases attention on inflation risk, it reduces confidence in purely financial instruments. This shift can alter how capital is allocated across sectors. Silver's current structure suggests cautious optimism, but not certainty. Momentum indicators support near-term strength. Structural resistance still challenges expansion. The coming movement above or below these key zones will clarify direction. For the business community, the correct response is not excitement, it is strategic awareness. If silver breaks higher and holds, it may signal renewed inflationary undercurrents and tightening supply-demand balances. If it rejects and rolls over, it may confirm that the broader corrective phase remains dominant. Either outcome carries consequences beyond the chart. Silver is sending a message. It is testing confidence. It is testing resistance. It is testing patience. Those who interpret the signal early can adjust strategy before volatility accelerates. Those who ignore it may find themselves reacting instead of preparing. And in uncertain economic cycles, preparation is often the difference between protection and exposure.